Hi, welcome to my conversation today with Anna. Anna is a tax lawyer and founder of Advotax Law. Anna helps clients who are being audited or were reassessed by the CRA resolve their disputes with the tax authorities. Thanks, Anna, for being here today.
Thank you very much, Madiha, for having me. It's a pleasure.
Wonderful. I'm so excited to talk about real estate and tax, and it's always a hot topic with my clients and almost, with real estate transactions. You've written a blog post that I find absolutely interesting, and I was hoping we could talk about that. It's 8 common tax misconceptions about selling real estate. So I've picked out a few I'd love for us to discuss. The first one, you say, is I've lived in the house, so any gain from its sale must be tax-free. So what can you tell us more about how we would treat your principal residence when you're selling it from a tax perspective?
So you're right. This is the most common misconception I hear from clients who then need my help to resolve their problems with the CRA. For whatever reason, they believe that if I sell a house, you don't pay tax because nobody pays tax. My neighbor didn't pay tax. My uncle didn't pay tax. I shouldn't pay tax when I sell residential real property. Well, the answer is more complex than that. In Canada, we have 2 types of property you can buy and sell. Type number 1 is called capital property. So that's property that you purchase with the intention to hold it long term and either use it or earn income from it. And inventory. Inventory is property that you purchase with the intention of selling it quickly and earning quick profit. So if you're running a business, you purchase t-shirts, that's your inventory, and you sell your t-shirts right away. And sometimes the difference is not very obvious. So let's say you purchased a condo and then you sold it after a short period of time. Was the condo your capital property or was it your inventory? Well, it all depends. Depends what intention you had when you bought the property. Did you want it to be your asset, your long-term asset, or did you want to flip it for a quick profit? So not many people understand that distinction. And then when it comes to principal residence, only your capital property can be potentially your principal residence. Your inventory, your t-shirts that you buy and are selling all the time cannot be your principal residence. So that's the most common misconception I hear.
So how would you define principal residence then?
Principal residence is your capital property. Coming back to our previous discussion, it's property that you purchase to hold long-term and earn income from it long-term with the intention. Of course, intentions change as people go along. So that's your capital property. That's your residential property. It can be your house, your condo, even your mobile home. And it's a property, it can be property in Canada, it can even be property outside of Canada. And that's the property that you, and I quote, habitually inhabit. Habitually inhabit is not, those are not the words we use in everyday life. So what does it mean? It means that once in a while, you use the property as your home. You don't have to use it all the time. You don't have to use it for 6 months, for 3 months. It's just once in a while, this property becomes your home, a place where your bedding is, and your toothbrush, and your change of clothes, and some food in the fridge. So a classic example is your cottage in Muskoka or Prince PEI. You may only visit that cottage for a week in a year, or even a weekend in a year, but that property is set up for you to enjoy as your home. Hopefully, it's not Airbnb during the remainder of the year. And that is enough for the stress habitually inhabit to be satisfied. So in my example with the cottage, let's say you have a condo in Toronto and a cottage in Muskoka. And you get to choose one property per year to designate as your principal residence. So in my example with a condo in Toronto and a cottage in Muskoka, I would sit and think, which one of these two properties appreciated better in any year, in this year? Let's say cottages went up the prices for cottages went crazy during the last year. So maybe I want to designate my cottage as my principal residence for this year and shelter the gain from that during this year when I sell the cottage. So that's how it works.
Oh, that's interesting. And you mentioned intention, intention to live in it longer term. In a case with the CRA, how do they determine what the intention was?
They assume the worst.
Okay.
They will assume that if they wanted what the CRA generally wants, they generally want to get as much as money as possible, legally, obviously, for tax revenue, right? So they want to be able to argue that that purchase that you made, that sale that you made, that was your sale of inventory. Why? Because then they get more taxes on the gain. Then the gain is taxed as business income, and you get taxed on it at almost 50%. So in order to prove that, they like to assume the worst. They like to assume that this is your inventory. And then it's your job, the taxpayer's job, to prove them otherwise. And there are certain factors that are in play here. So the CRA will look at your occupation. If you are someone like yourself, Mediha, if you are a real estate agent, they're gonna say, you're a real estate agent, so you're in real estate all the time, you know the industry, you know the business, you probably wanted to flip it very quickly. They're gonna look at the history of similar transactions. So they're gonna look at how many properties you bought and sold over a period of time, let's say 5 years, 10 years. They also will look at how many properties your family members will bought or sold. So you can't fool them there. Some people think they're smart enough, they just put their properties into their family members' names. No, the CRA can look through it. They will look at how you finance the property. Generally, if you buy a property for an extended, like for long-term investment, you finance it in a way that you can afford to maintain that mortgage long-term. But if you're buying something for a quick flip, sometimes people resort to B lenders and just super expensive mortgages because they know they will resell the property very quick. And they will look at how you, whether or not you took any steps to market the property, or like to increase the value of the property while you held the property. Let's say you bought an older house and then immediately you started doing renovations and you changed your kitchen, your bathrooms, and then you put it on the market. To the CRA, that's an indication that it was really a business project for you. Probably you weren't planning to hold in the property for a long term. So, another big factor is the CRA is going to look whether or not you could afford to maintain the property for a long term. And that's an argument a lot of my clients have that's a factor a lot of my clients are struggling with, because they say that I wanted to hold this $2 million property and rent it, but that, or just wait for it to appreciate.
Right.
But the mortgage is very expensive on that property, and the person, if that person reports only, I don't know, a very modest income, then the question is, well, how did you think it would work? How did you plan to hold it long term? They will look at any evidence of you trying to rent the property. So if your plan was to rent the property long term, presumably there would be some evidence, like you would contact a real estate agent, you would list it, you would show it to potential renters, and then something may not work out, or like something could have happened and you decide to sell. So all those little things indicate what your intention was, and the CRA generally assumes the worst, and then it's your job to prove them otherwise.
Yeah. And how long can a process take?
The process, the audit process, I think the shortest I've had was maybe 2-3 months. That was the shortest. The record that we've had was the auditor. We're laughing about it. The longest I've seen in my practice was 6 years.
Yeah.
6, and we're complaining, and we thought it was inappropriate, and the CRA said, no, too bad, so sad. That's how long it took us. It is what it is.
Wow. So you, and it's one of your misconceptions as well, and about the time frame. So if I hold my property for more than 1 year, the property automatically qualifies as capital property, and I only have to pay tax on capital gain. So, and I have these conversations with clients a lot. I work with a lot of investors, and always, the question comes up, and there is this misconception that it's a year. A year is this defined term. If you hold it for 1 year and have a utility bill there, etc., prove that you've used it, you're good. You're safe with the CRA. Is there a defined period of time?
No, very good question. And no, there is no 1 year rule in the legislation. As of now, there is no 1 year rule in the legislation. There is this general practice that, well, if you, so this is what is true. If you hold it for less than a year,
yeah,
most likely the CRA will look at it and audit you. So there's a very high chance that the CRA will look at this transaction and audit you. It doesn't mean that you're in trouble. It doesn't mean that you're safe.
Right.
It just means that the CRA will look at that transaction. It's quite safe to assume. Now, what they decide, that depends really on your intention and why you sold the property. So that's another serious consideration that the CRA will look at. Why did you sell the property? If you were planning to hold it long term, then why suddenly your plans changed? And here you better have a very good reason supported by evidence as to why your plans have changed. Things like, oh, I didn't like the color of my walls anymore, doesn't work. It's just just try it on yourself, try it on your friend.
Yeah.
People will not believe you.
Yeah.
People don't buy expensive real estate, and it's expensive here in Ontario. People don't buy expensive real estate just to decide 6 months later, oh, I don't like the color of the walls, or oh, I don't like the neighborhood. Well, the neighborhood was there as you were trying to buy the property. What has changed? So there must be something unforeseen that has happened, either in the neighborhood or in your life, that that influenced your decision to sell the property. So that could be a divorce, an illness, a change of work location where you had to relocate for work. What else did we have? I had a file where a child developed an allergy to something in the house. So that's something they could not know before they moved in.
Right.
But they knew maybe 6 months after living in the house. So things like that are the reasons that normally, make sense. Things like I realized I couldn't afford the property anymore. Again, that's a difficult one because you knew the price of the property as you were signing that agreement of purchase and sale. So you knew what your mortgage would be. How come your perception of what's too much, what's not too much have changed 6 months in? So these are the things about the reason for selling the property and holding it for a short period of time. So if you have that very good reason for selling the property, it doesn't matter how many months you held the property. You can hold it for 1 month, 2 months, 3 months. Let's say, you move in and then you have a huge fight with your significant other and you decide to separate. I don't care how long you held the property, that we knew that was supposed to be your principal residence, and then something you could not have foreseen happened. You had a very serious fight, you decided to separate, sell the property. I don't care how long you held the property. So that's that's for holding period below 1 year. Generally, it's not a good idea. Generally, that indicates that you are in business of flipping homes, unless you have a very good reason. If you held the property for more than 1 year, the longer you hold the property, the more likely it is that it was your long-term investment. But I have seen audits of properties sold after 1 year, even after 2 years. If there is something in the pattern of behavior of that person that indicates that's this person's way of making a living. And the classic example is what we call them house hoppers, people who hop from one house to another every year and a half, 2 years. And they say, well, I only had one property, and then I moved to another, and then I moved to another. So 1 year, there is no 1 year rule. One exception. Just recently, we had our federal election, and in the Liberal Party platform, there was a so-called anti-house flipping tax. And this is a proposed tax. It's not the law in Canada yet, but if it becomes the law, we will see a rule that says, if you held the property for less than a year, here that we will have that 1 year rule. If you held the property for less than 1 year, then that's it. You're in business. We're gonna assess you as if you were in business of buying and selling houses. So that's the rule that may be introduced, but it's not there yet.
Oh, that's interesting. So then you have this defined period of time, right?
Yeah.
Which I guess we don't know yet, but would the assumption be anything past the 1 year 1 year time frame is exempt then?
Well, everything that I've seen, no, the opposite is not necessarily true.
Okay.
So if you held the property for 14 months, it doesn't mean that you're automatically in the clear. No, it doesn't mean. All it means is that if you held it for less than 12 months, then the tax can apply to you. But I believe there are still exemptions for people who are getting a divorce, or like all those like serious life situations. There are exemptions for those people. So really, the tax is doesn't really change the law as we have it now. It just brings more structure into the analysis with that time period. but the law is roughly the same.
So you mentioned the patterned behavior of house flipping, for example, right? So what if I've been flipping, I'm on to my 5th house, and the CRA just for some reason, I'm flagged now. Can they go back to my past 5 homes and audit that and tax me on those?
The short answer is it depends.
Okay.
The very helpful answer, right? So it depends on many things. Number one is whether or not the CRA chose to audit you for income tax or for HST.
Okay.
Income tax, we all hopefully file our tax returns. When we file our tax returns and we get our notice of assessment in mail, then there was something called the normal reassessment period starts running. What it is that period when the CRA gets to audit you. Without any questions asked, they have the automatic right to reassess you. So generally that period is 3 years after your notice of assessment. So for 3 years, the CRA definitely can go after you, and then there are exceptions for them to be able to go after you even after 3 years, and those exceptions are quite broad. So if the CRA can prove that you were careless in preparing your tax return, meaning that you knew that something was wrong, but you were like, it's good enough, close enough. I'm not going to investigate it. I'm not going to receive legal advice, accounting advice. I'm just going to take a chance that this is correct. So if they prove that you were careless, they can go after you even beyond that regular 3-year limitation, a 3-year reassessment period. But if they cannot prove it, then they're out of luck. They can go after you beyond 3 years. So this is income tax. HST. HST is a totally different ballgame. Why? Because people who flip houses and don't pay HST, a lot of them choose not to file any HST returns, right? Their position is like, I'm not going to pay anything. I'm not filing any returns. Because if you don't file your return, that clock that we want to start ticking, it never starts ticking. The reassessment period never starts. So technically, the CRA can go after you indefinitely. And just recently, I heard of someone who was reassessed, who is being audited, not yet reassessed, who is being audited for a flip they did in 2010. How crazy is that? That's 11 years ago.
Oh, wow. Right. So file your correct returns.
Yes, that's the message.
Right. So I work with a lot of investors and extensive work with pre-construction condos. And one of the hot topics is assignments, which is one of your misconceptions as well. I sold my condo on an assignment. Why would I pay any tax? The condo is not even built yet. How are condo assignments, the profit you make and the deposit that you get back, how are those two treated?
Okay, this is a hot topic in the industry for sure, mostly because the position of the CRA is still different from the position of the courts, from case law. There's difference between what the court said and what the CRA still says. So that's what we're trying to investigate. We actually ask the CRA to comment on that issue. So assignments. What is an assignment? Assignment is when you enter into an agreement of purchase and sale for a property that will be constructed in the future. And in the case of condos, that's sometimes like 3, 4, 5 years from now. So what you hold in your hands is a piece of paper that says, so-and-so agreed to purchase this condo from this builder for this much money. Now, what you hold is an asset. That's an asset. That's property. That's your right to purchase real estate for a certain price. So during an assignment, you assign your rights to this agreement to somebody else for a consideration. In other words, you say, okay, you, Joe, now you pay me $50,000, and I'm gonna allow you to step into my shoes for this agreement. So you will replace me in this agreement, and I will not have the right to buy the condo, but now you will have the right to buy the condo. And for that, I want $50,000. Now, the mechanics is clear, but the tax implications are quite tricky. So if you are in business of buying and selling real estate, if you are an experienced flipper and you buy and sell condos or houses on assignments all the time, or even if for this one particular reason, in this particular case, you decided to flip something quickly, then what the income you earn from your assignment, that's your business income, minus obviously your deposit. So let's say if you, if your original, the price for your original condo, let's say was $300,000, the builder has asked you to pay $60,000 deposit, 20% down. You pay that amount, the builder now has $60,000 from you, and then you assign the rights to this agreement to a purchaser for an additional $50,000. So in this case, $50,000 will be your business income that you have to report.
Profit.
And profit, yes, that's your net profit, that's right. You have to report and pay tax on it on the full rate. It's not your capital gain. And another thing to consider is HST.
Right.
When you sell the rights to your agreement to somebody else, that's an event that's subject to HST. And now the tricky part is, how do we calculate HST? Do we calculate it on 50,000? Or do we calculate it on 110,000, which is the sum of your deposit, 60,000 plus 50,000 you get from the purchaser? So do we calculate it on 110,000? So technically 60,000 is your after-tax money, it's your deposit. Why would there be HST on it? But the CRA says, nope, we want you to collect HST from your purchaser on $110,000 in my example, on the entire price of assignment, which includes the deposit and the markup, whatever it was. So the CRA says, we want you to collect HST, remit it to us. So in my example, 110, that if you agree to assign your agreement for 110, you will have to calculate the HST included in that $110,000 and pay it to the CRA. So roughly, in this case, it will be roughly just over $10,000 that you had to remit to the CRA. And it is problematic, we believe, because there was a Tax Court of Canada decision that said, no, that's not fair, and people should only pay tax on $50,000 HST. So that's still up in the air. That's what we're trying to figure out still with the CRA. We ask for technical interpretation and their guidance as to when they would follow that court decision and when they would follow their official position. And their official position is still, we charging HST on the entire assignment price. So again, just to clarify, that HST implications apply to people who are in business. buying and flipping condos. If you're not in business, if you, let's say, bought signed an agreement of purchase and sale for a condo, and then something happened, you decided to move away from Canada, or you moved to a different city, or you decided to buy another property for whatever reason. So if you can prove that your initial intention was to use it as your personal property, and then something happened, you can use it as your personal property, then there should not be HST implications, but there will still be income tax implications in the form of, in this case, capital gain.
On the 50,000, the profit.
Yeah.
Oh, that's interesting, because I think most people are under the assumption that this is a way to quickly flip your contract, and you don't actually have to declare it, or you can evade some part of it. The part about the HST on the total amount is not very clear.
Right? Oh yeah, and the reason people think so is because for the longest time, in I think starting from early 2000s and until maybe 2017-18. So that's for an extended period of time, the CRA paid almost no attention to assignment flips.
Right.
Even though the law hasn't changed. Some people think, oh, they changed the law. No, they haven't changed the law. The CRA was just not thinking about assignments as a way to collect tax revenues, and now they have, and they have the law to do that with some questions, but in any event, they can do that, and they do that very aggressively, and they do that by sending what's called a request for information to builders. So if you think that nobody knows that you flipped something in an assignment, you are wrong, because your builder may get a request like that in a brown envelope from the CRA, and they will release your name to the CRA and all other assignees or assigners. So, and these are very common lately, starting from maybe 2018-19. So I would encourage everyone to, if they're worried about your tax obligations, to speak to your lawyer and see if there's something that you need to correct.
Oh, that's a really great point, Anna, that the builder has all the information of the original buyer, right? That's always on file because that was the original contract between builder and buyer A. So yep, they will be releasing that information if it came up.
And these requests are extremely common. So
oh, wow.
You gotta be very careful.
And are you finding the CRA is actively looking at new buildings that are completing and looking for assignments now?
I do know that it's assignment audits are extremely common. I do know that whatever requests for information they issue to builders, the builders generally comply, because there's very little, like there are no excuses for them to get away and say, no, I'm not going to comply. I'm not going to tell you what, I'm not going to release the names of my buyers. No, the builders must comply. And the result of it is assignment audits are common. I'm not, I don't have enough information about what's going on inside the CRA. I'm not an employee of the CRA. What I see on the other side is quite active.
Great. Well, thank you, Anna. This was awesome. I think we learned some really great information and helped demystify some myths around taxes, which always is a hot topic in the real estate world. And if you wanted to share one last tip or advice on these topics. File your taxes.
File your taxes. Well, I guess what comes to mind as a recent case when the taxpayer bought and sold 5 properties. I blogged about that case too. And what saved him is that he went to his accountant and he told the accountant, this is what's going on. How do I file my taxes? And the accountant said, this is how you do it. So 5 years later, the CRA came after the guy, but the guy had a very good excuse. He said, listen, I'm just I'm in construction. I know next to nothing about taxes. I did what any reasonable person would have done. I went to my accountant, who's a professional, and asked him the right questions, gave him all the information, asked him questions. I followed professional advice. And I did everything the way my accountant told me to do. So that alone saved this taxpayer from reassessment beyond the normal reassessment period, which we discussed earlier. So the fact, I think, that he spoke to his accountant and his accountant said, this is the way to do it by law, and he thought he did everything right. The court said, well, that's it. It's statute barred. You can't go after this taxpayer anymore. So the lesson of the story, don't ignore your professionals. They may help you. So even if, like in this case, they may have gotten wrong advice, it still helped that they had a professional in their life. So be nice to your accountants, and of course, be nice to your tax lawyers.
That's great advice. Well, thank you, Anna. And if anyone wants to reach Anna, you can Advotax online. Right? Thanks, Anna. This is great.
Thank you for having me. Thank you.